All right, so let's jump into impairments. And so when it comes to an impairment, this idea of depreciation, depletion, amortization, I mean, that's kind of this idea of the normal consumption of assets. And so, the fact is we're supposed to have these benefits over a longer period of time. And so the depreciation, depletion, amortization are kind of meant to capture that. However, it is possible that you could have an abnormal decline in future benefits or service potential. And when that happens, that's called an impairment. So again, to be clear, this is an abnormal impact on the future benefits of an asset. So that's what that's meant to capture. Um, all right, so some of them are, fairly obvious, like a storm blows through and destroys a building, right? So you're kind of like, okay, clearly the future benefits of this building are different than what we had anticipated because it just got leveled. Others can be a little more subtle, like goodwill is an example. So if you're Microsoft and you pay $1 billion for, some company, more than likely there's going to be goodwill, and that goodwill is meant to capture the intangible value like brand name, synergy with your current operations, whatever it is. And let's say they had like $300 million in goodwill as part of a transaction. Well, it's possible that at some point in time they determined that, boy, this acquisition really didn't go as well as we thought it was, and so really the value isn't there that we thought, and that would be what's called a goodwill impairment. But that's kind of hard if you think about how you reevaluate a prior acquisition. I mean, that's not an easy task. And so, again, some are obvious, some are subtle, but we need to account for them. Now, there are some differences in the way that you account for impairments. Held and used is differently than held for sale. Held and used is the example we're going to walk through. Held for sale is really more like an investment, and we're going to cover that in chapter 12. And it's pretty simple. You compare the book value to the fair value, and you impair it for the difference, um, less some selling costs and things like that. But at the end of the day, it's handled kind of like an investment, versus held and used. There's a little more of a process that we need to sort of navigate. And then the second thing is impairments are different for assets that have a finite life versus an indefinite life. So like finite life building, equipment, those are kind of the easy ones we can all think about. Vehicles would be another one. An indefinite life, that's good. Definite life, that's goodwill, that's land, things like that. We do things differently depending on the life of the asset. So for assets that are held and used, if there's a finite life, then essentially impairment tests must be prompted by something. So there's got to be some event or circumstance that indicates that the situation has changed. And so there are scenarios where, obviously that might happen. And here's just sort of a quick list. I don't want to get too into the weeds on this list. But again, like basically something significantly happens to an asset. And so you're going to evaluate that asset for an impairment. And so, again, lots of details in this. You can read through this. I honestly don't want to spend a lot of time on it. I'd rather get to sort of the two-step process and how we evaluate things. How do we know that an impairment loss has occurred? First of all, we do what's called a recoverability test, which basically means that we look at the undiscounted sum of estimated future cash flows from an asset. And if that's less than the asset's book value, then essentially we have checked that box. In other words, we're not going to be able to recover those cash flows. And so at that point, then an impairment loss has taken place. So again, you compare the sum of estimated future cash flows from an asset to its book value. If that sum is less than the book value, then there is an impairment. The measurement is the second one. Again, so something has happened. I'm going to be very, very clear. This isn't normal use. Something has happened. And then the second step says, okay, we've concluded that an impairment has occurred. And so now we're going to record that loss. And the loss is the difference between the asset's fair value compared to its book value. So again, a lot of times the fair value is very low. And so just sort of walking through that. All right. So in this example, Ford Air Company purchased a fleet of delivery trucks on January 1st, 2024. The cost for the fleet was $500,000. 49 assumed the fleet would have a 5-year useful life and a $50,000 residual value. On June 30th, 2025, the entire fleet was damaged in a storm. 49 determined that the fleet was no longer usable and that the vehicles could be salvaged for scrap metal for $15,000. We're going to try something here. I think there's a slight mistake on the next slide, so I'm going to correct that real quick. Give me 1 second. All right, back on this. Those that have me in class, they might have remembered the mistake that I made, but I figured it out. All right, so let's provide the necessary journal entry. So first of all, there was a significant change in the physical condition of the asset. And so when we look at recoverability test, the undiscounted future cash flows from the vehicles is 15,000, which is just that scrap amount, and the book value is 365,000. And so clearly in this case, the undiscounted future cash flows are less than the book value. There was a significant event. Therefore, there is an impairment. We did not pass the recoverability test. Measurement. So the fair value is 15,000 compared to the book value of 365. Therefore, the loss is $350,000. So how do we handle this? Well, we've got to remove the accumulated depreciation. We've got to reduce. Now, I want to be very clear here. We talk about reducing the vehicle balance. Remember, we didn't actually get rid of the vehicles. So we're not getting rid of the vehicles, but basically we're writing them down to their scrap value. That's essentially what we're doing, is we're basically adjusting them down to that fair value. So I just want to be very, very clear. We're not removing all of the vehicle balance. We're just reducing it to reflect that scrap value, that $15,000 fair value. And then, of course, we're going to record that loss. And so the first thing again is the accumulated depreciation. And I probably should have shown the math here, but if we kind of go back to the depreciation, there's $450,000 of total depreciation. And so, all of 2024 would have been, whatever that is, $90,000. And then half of 2025 would be like another 45. And so the accumulated depreciation as of the event date would have been $135,000. So we remove that $135,000. Again, to be clear, we write down the vehicles to that new fair value. So the original capitalized cost was 500,000. Their scrap value is 15. So we're going to write it down 485,000 so that the vehicles sit there at $15,000. And then the loss is the difference. Assets with an indefinite life. So they're treated a little bit differently. In this case, they are tested for an impairment annually, and you have to figure out, okay, is it more likely than not that the asset is impaired? If it is more likely than not, then it's impaired, then you record that loss. Again, more likely than not, again, the key here is that that it will not be recoverable. In other words, those future cash flows are permanently below the book value. And so if, because something like goodwill, it could fluctuate, right? The value of an acquisition might look a little bit different one year to the next. And what we're saying here is it's got to be more likely than not that the value truly has fallen below that book value. So it's not like an annual up and down thing, because once you write it down, that's it. You don't write it back up. You only can write something like goodwill down. And so just to be clear, it's kind of a big deal when you write something down, but it is something that does happen. So if fair value is less than the book value, then the asset is impaired. Again, it's got to be more likely than not, and I would say there's got to be some sort of permanence to it. One thing, just that, sort of as a note, the most common asset that's impaired is goodwill. While it's impairments in general are rare, if you see an impairment, most of the time it is goodwill. And so there are several nuances to goodwill you can review, but we're not going to be testing you on all those nuances about goodwill. So a company acquired a competitor for $250 million, and 75 million of that was goodwill, which means their identifiable assets were 175 million. And then on December 31st, they conclude it is more likely than not that the fair value of the acquired company is less than the book value. At that time, the book value of the acquired assets was 225 million. including 75 million in goodwill. So what that's saying essentially is there was some, obviously depreciation of those identifiable assets. And the estimated fair value of the equipment, or sorry, of the acquired company was 165 million. Dang it, I remember just another error here. Give me 1 second. Okay, hopefully this works. All right, so essentially, again, same sort of bring it back up. So we need to do the journal entry to correct this. All right, so looking at this, again, the loss, once you determine it's more likely than not, the loss is pretty straightforward. You just take the fair value and subtract the book value. The fair value is 165 million. The book value is 225 million. That difference is 60 million. And so we're going to impair the goodwill. Again, we're assuming that the identifiable assets were not impaired, right? So we're saying this is attributable to the goodwill account. And so the loss on impairment would be recorded at $60 million, and we're just going to reduce that goodwill. Assets that we're holding for sale, again, the simple test, you compare the fair value minus some sort of selling cost to its book value. If the fair value minus that selling cost is less, then you have an impairment. So it's kind of similar to what basically you do for a lot of investments, other than taking into account the cost of sale. And so it's a fairly straightforward example when you have something that's being held for sale. All right, subsequent events. So basically there's some things that can happen after. You know what, actually I'm gonna stop. I'm gonna do one more. I'm gonna break this up into two real quick. And so I apologize for that, but we're just gonna kind of break this up into two instead of doing all at once real quick.